The Bank of Canada has issued a stark warning of a productivity emergency, as they're calling it, and they're suggesting there might be an imminent economic or inflation crisis if we don't get our act together. Also, Ontario's 2024 budget came out yesterday. It shows a huge deficit and a spurge on healthcare, but it does steer clear of tax hikes and it promises a rosy future just in time for an election. A division within the Bank of Canada over potential interest rate cuts could exacerbate inflation concerns, and Canada Goose is slashing 17% of its global workforce, signaling potential trouble beneath the surface of this luxury retailer. Today is Wednesday, March the 27th, 2024. Let's get started with today's top stories.
You know those signs that say, in an emergency, break the glass? Well, it's time to break the glass.
Well, that was Carolyn Rogers. She is the Senior Deputy Governor at the Bank of Canada at a speech that she gave recently in Halifax. And in her talk, she raised an alarm over what she's describing as a national emergency due to weak productivity, low levels of business investment, which are complicating efforts to manage inflation, and they're threatening to diminish our living standards. During her speech, she emphasized that Canada is falling further behind the U.S. and other comparable nations in terms of economic output per worker. She highlights the lack of business investment, limited competition, and the failure to adequately integrate skilled immigrants into our workforce. She also noted that Canada has fallen behind other G7 countries, with only Italy now experiencing a greater relative decline in productivity. She pointed out that Canada's productivity, which is measured by the economy's output per hour of work, has been lagging behind the US for quite a while now. That gap has only widened since the pandemic. She also attributed these issues to a weak competition within Canada and regulatory uncertainty. She argued that excessive protection of local businesses, though sometimes can be justified, they also can lead to inefficiencies and stagnation in productivity. She did highlight the importance of integrating new Canadians effectively into our economy, and she noted that there are a lot of skilled immigrants who end up in jobs that they don't fully utilize their capabilities, and this leads to a cycle of low wage and low productivity employment. She also says that improving the match between job worker skills is critical for enhancing Canada's economic future.
Too often, new Canadians are working in jobs that don't take advantage of the skills they already possess. And too often, these people wind up stuck in low-wage, low-productivity jobs.
To be clear now, weak productivity isn't just a problem for economic growth. It also makes controlling inflation more challenging for the central bank. When you think of it, higher productivity, that's a good thing. It allows companies to increase profits and increase wages without passing those costs onto consumers. And this, of course, mitigates these inflationary pressures. But on the other hand, when productivity is lagging, like we're seeing here right now, labor costs tend to contribute to higher prices. Finally, Rogers stressed the need to continue efforts to bring inflation under control, hinting at the importance of the upcoming rate decision, which comes up next on April the 10th. Ontario's Finance Minister, Peter Bethlenfalvy, he unveiled the province's 2024-25 budget yesterday, and it shows a challenging fiscal landscape marked by slower economic growth, inflation, and rising interest rates. But despite these hurdles, the Ontario government has committed to avoiding any tax or fee increases for residents, and it still promises significant investments in infrastructure, healthcare, and various other services. The province is facing a notable increase in its deficit, as projecting it to nearly double from last year's forecast to $9.8 billion. And this does mark a shift from earlier predictions of achieving a balanced budget by 24-25. However, the budget does outline a plan to reduce the deficit to $4.6 billion by 25-26, and then aims for a surplus of $500 million by 26-27, which magically just coincides with the next provincial election. I'm always amazed at how smoothly that always works. The increased deficit, they're saying that it is attributed to a number of factors, including the extension of the gasoline tax cut and necessary back pay for public sector's workers. And this is due to a legal setback they had over the wage cap legislation they'd introduced. Key investments in the budget focus on support for Ontario's 444 municipalities, including a substantial allocation for housing construction facilitation and water system improvements. And this aims to address the challenges that so many municipalities are facing in expanding housing infrastructure due to the resource constraints that we see today. In terms of healthcare, the budget earmarks billions of dollars for enhancements, notably a $2 billion investment over 3 years to boost home care services and compensation for personal support workers and nurses. There's nearly $1 billion that will be allocated for hospital funding in 24-25. The budget also plans for the establishment of a new medical school in Vaughan, and that's affiliated with the York University, focusing on training family doctors. Addressing the aftermath, as I alluded to earlier, of Bill 124, which was regarding the collective bargaining, the budget here allocates significant resources and funding to pay back for these public sector employees, including those in healthcare and education. And this follows the Ontario Court of Appeal ruling against this wage cap law. The total compensation owned there is estimated to be at about $6 billion. Also, auto insurance reforms are another highlight, with the government aiming to provide drivers with more affordable options, a broader range of coverage choices, although specifics on the rate adjustments were not detailed. Additionally, the budget promises $46 million over 3 years to enhance police patrols and response times in the GTA. That includes funding for 4 new police helicopters. And finally, highlighted the budget, a $200 million community sport and recreation infrastructure fund that's going to support the development of sports and recreational facilities, and it will be offering municipalities financial assistance for specific projects over the next 3 years. Looking for a portfolio that suits your needs and goals? Well, BMO ETFs and mutual funds, they offer a range of solutions, from innovative smart beta strategies to core fixed income and equity funds. Whether you want to invest in Canada or globally, across asset classes or market views, BMO GAM has the experience and the insights to help you reach your investment goals faster. Plus, you can align your portfolio with your values and support climate action through their suite of sustainable portfolios. You can learn more about how BMO can help you achieve your financial objectives today by visiting bmogam.com. The Bank of Canada is signaling a possible shift in its interest rate policy, and it's suggesting that rate cuts could be on the horizon for this year. But as always, those are going to be contingent upon the economic and inflation trends that do align with the bank's forecasts. During a press conference in Ottawa earlier this month, both Governor Tiff Macklem and Senior Deputy Governor Carolyn Rogers, they shared insights into the central bank stance. Despite the consensus on the prerequisites for reducing the rate policy, namely witnessing further and sustained easing and what the bank refers to as underlying inflation, there is a lack of agreement amongst the governing council members regarding the timing for these adjustments. The deliberations, they revealed differing opinions amongst the council members about the timing for meeting the conditions and the associated risks to the outlook. And this divergence sort of stresses the central bank's cautious approach to monetary policy adjustments. And these are especially highlighted by Governor Macklem's remarks on the potential for rate cuts. He emphasized progress in tackling inflation, but he indicated that the current moment isn't suitable for reducing interest rates, and suggested a preference for avoiding premature actions that might necessitate a reversal in the policy direction will be a high priority for them. Last week, the Federal Reserve in the U.S., they maintained their key interest rate. For the 5th consecutive month, they left that unchanged. And they did signal potential rate cuts in 2024. Their forecast actually seems a little bit more conservative for 2025, with a slight upward adjustment for inflation expectations. And this contrasts with the Bank of Canada's reluctance to be explicit when it comes to future policy moves, although Macklem did hint that there would be a more measured pace in rate adjustments compared to the rapid increases that we've seen previously. Recent data here in Canada, it showed a continued decrease in the inflation rate that fell to 2.8% in February, and it does support the anticipation of the Bank of Canada, starting to reduce interest rates somewhere around mid-year. I'm hearing June right now as the most likely time. However, the bank does remain wary of cautionary pressures, particularly from the housing sector, which could delay achieving that 2% inflation target rate. The role of shelter costs, most notably mortgage interest and rent, the role that played in driving February's inflation figures just further complicates the policy landscape here. The next Bank of Canada rate announcement is on April the 10th. Canada Goose has announced that it will be cutting 17% of its global corporate workforce. And CEO Dan Rees, he communicated the decision to reduce staff, and he says that it is a strategic step aimed at refining the company's efficiency and focusing more on brand, design, and operational initiatives. The layoffs are part of the company's bigger effort to better position itself for scaling in the future. Rees said This is sad news for me to share because we have individuals leaving the organization today who were instrumental in making Canada Goose the business it is today, and I am personally grateful to each and every one of them. The company didn't disclose the exact number of employees who will be affected by this decision. However, they had a workforce of about 4,760 people as of April 2023, so the amounts, the layoffs rather, will be a considerable amount here. The company spokesperson stated that these cuts are crucial for the company's effective scaling. This restructuring comes after Canada Goose experienced a challenging winter with unusually warm weather, and that delayed the onset of its peak parka sales season. Jonathan Sinclair, he's the company's CFO, and he highlighted the impact of weather on consumer purchasing behavior, noting that the colder weather typically prompts parka sales. And he said, the first cold snap prompts business. The longer you wait for that, the later the sales period starts. And I think that is what we've experienced this year. The company is facing a challenging consumer environment globally, they say, and these steps that they're taking now are seen as vital steps towards adapting to the current economic dynamics. Canada Goose, they anticipate these changes will result in immediate cost savings and a more agile operational structure, and this will set the stage for the company's continued evolution and growth into fiscal 2025. Please don't forget to subscribe to our Pulse newsletter. That goes out every weekend to help you keep informed. Also, if you haven't already visited our Investing Academy website, I will put a link for the newsletter and the Academy here in the video's description. Again, thank you so much for watching. We'll see you in the next video.